welcome. So this is Chapter 17 in Michigan's Money and Banking textbook. We're looking at exchange rates, and there's actually a couple chapters that relate to exchange rates and how monetary policy in the central bank interacts with exchange rates. So this chapter is understanding the basic mechanics of it, and we're going to split it up into two sections. The first looks at exchange rate movements from a long-run perspective, and then the second one, later on, we're going to talk about exchange rate movements in the shorter term and what drives those two things. So before we do that, we're just going to lay some basic groundwork down. Exchange rates are, in essence, the price of a currency in terms of another currency. There's two ways in which we can characterize exchange rates. The first is what's referred to as a spot exchange rate. So that is literally just the market value of one currency relative to another right now at this moment. And we can also have what's referred to as forward exchange rates. So the idea there is that you can commit to buying foreign exchange at a later date at a pre-specified exchange rate. And so that's beneficial for a variety of reasons because it provides certainty over future transactions in cross-country trade flows. So the way that we think about exchange rates can be a little bit confusing. So it's important to really understand the definition of exchange rates and how we provide the conventions of expressing exchange rates. So exchange rates are going to be reported in the amount of domestic currency per unit of foreign currency. And so that's often dictated by market convention in terms of how it's reported in the media and in financial markets. So as an example, you can have $1.60 US per pound. That's equivalent to 0.625 pounds per dollar. It means exactly the same thing. But in terms of the financial markets, it's market convention. If you open up a newspaper for these things to be reported in the number of dollars per UK pound. Okay. Now again, those things can be confusing because they mean essentially the same thing, but it's going to be important here in a moment when we think about this foreign exchange model that we're going to set up. And so what's going to happen here is we're going to be measuring the quantity of domestic assets. So in all of the examples that we're going to look at, we're going to think of the U.S. economy as the domestic economy. And so we're going to be concerned with the quantity of dollar assets and dollar-denominated assets. And we'll explain a little bit later on what that means. And so in terms of thinking about the exchange rate in this convention, we're always going to be measuring the value of domestic denominated assets in the terms of the amount of foreign currency it takes to buy 1 unit of domestic assets. Okay, so in other words, what that means is that if we're looking at the U.S. economy and we're considering the dollar exchange rate, it's going to be the number of euros per unit of domestic currency, in this case, per unit of dollar. So in thinking about exchange rate movements, there's two basic ways that we can think about this. There's an appreciation of the currency, so that just means that a currency appreciates in value or increases in value relative to another currency. So as an example, if we have the dollar-euro exchange rate, if that goes from $1.40 per euro to $1.35 per euro, then what that means is that the dollar appreciates relative to the euro. The intuition is that it takes less dollars to buy the same amount of euros or euro-denominated goods as it did before. And so because of this, the interpretation is that we can buy more foreign goods, we can buy more European goods with the same amount of currency that we had before. So in that case, we say that the dollar appreciated relative to the euro. We can have the depreciation, which is going to be the exact opposite. So that's when a currency decreases in value relative to another currency. In this case, suppose we have the dollar-euro exchange rate moving from $1.25 per euro to $1.32 per euro. Okay. Again, the interpretation is that it takes more U.S. dollars to buy the same amount of foreign currency and hence the same amount of foreign goods as it did before. So in that case, we say that the dollar depreciated relative to the euro. We buy less foreign goods than we did before if we're in the U.S. and we have dollars. And in particular, the interpretation then is that we need more dollars to be able to buy the same amount of euro-denominated goods as we had before. Why is all of this important? Well, again, this gets at the heart of thinking about why we care about exchange rates and why we care about underlying things that drive exchange rates. Well, There's a lot of reasons why this is important. So first of all, there's trillions of dollars of currency that's traded in foreign exchange markets on a daily basis. So it's a huge market. As we've seen over the last 10 or 20 years, global trade is important. It becomes increasingly more important as more countries become open to trade. Emerging markets in particular typically are more dependent on international trade based upon just the structure of their economies. And so because of that, they're much more concerned with exchange rate movements. And so not surprisingly, exchange rates can also affect trade flows, as we'll see here in a second. So with the examples that we talked about before, we have an example of exchange rate appreciation. In this case, when the dollar moved from $1.40 per euro to $1.35 per euro, we said that the dollar appreciated. So the idea here is that we can buy more foreign goods with the same amount of dollars that we had before. And so what is going to happen in that case is because we can buy more foreign goods because of this exchange rate movement, we're going to be able to increase the amount of imports in our domestic economy. So we're buying more foreign goods. And the flip side of that is that our goods become more expensive to other countries. And so as a result, the amount of exports that we have goes down. So when we put both of those things together, what that means is that our net exports are going to go down. They're going to decrease. If we flip that around, again, we have the example that we looked at before. Our dollar-euro exchange rate, if that moves from, say, $1.25 per euro to $1.32 per euro, as we talked about before, this is the dollar is depreciating in this case. And so as a result, we buy less foreign goods with our domestic currency. And so because of that, imports into the U.S. are going to go down, right? So it's more expensive if we're in the U.S. and we're trying to buy foreign goods. So we're going to buy less imported goods. The flip side of that is that our goods that we produce here are going to become cheaper in foreign countries, okay? And so that results in an increase in exports. So again, we put both of those things together. That's going to result in an increase in net exports. And so the punchline, and this is why this is important to the book, and we'll see exactly why this is that it turns out monetary policy can impact exchange rates. And of course, that's going to impact this net export channel. That's one of the things why monetary policy is important to this broader story of exchange rates. So the goal then is to think about what are the things that influence exchange rates over longer periods of time, okay? It turns out there's several, and I'll talk about these momentarily. The first is relative price levels. If there's price differentials for particular goods in different countries, then that can affect exchange rates, and we'll see how that works. Trade barriers can also impact exchange rates. Simple preferences between what people want to buy in one country versus another. If we have a particular affinity for French wine over California wine or something like that, then that can increase demand for one relative to the other and influence exchange rates. And then productivity differentials are important, which we'll talk about here momentarily. But if we control for all of these factors, then what this leads us down the path towards is this idea that we should expect the law of one price to prevail. So the idea is simply that if we control for these things, exchange rate movements should dictate that we can buy the same goods in different countries for essentially the same price. And that's what this law of one price suggests. So to give you an example, if we have the dollar-euro exchange rate is $1.25 per euro, okay, and suppose we could buy a Mercedes-Benz for $75,000 in the U.S. Now, we should expect that Mercedes-Benz in Germany, if this law of one price holds, is also going to be the equivalent of $75,000. So if we have $75,000 in the U.S., we go to the dealership and buy the car. Or alternatively, we should be able to transform our dollars into euros for the exact same price and buy the exact same car in Europe, in Germany. And so that would occur, of course, if the price of that Mercedes-Benz, as we translate the $75,000 into euros through this exchange rate, then what that suggests is that the price in Germany should be 60,000 euros for the same automobile, for the exact same good. And so, in other words, this law of one price applies if it's the case that the Mercedes-Benz in the U.S. costs $75,000, or we account for the exchange rate effects. It turns out that the same Mercedes-Benz in Germany is going to cost 60,000 euro. If it's not the case, then you would expect exchange rates to adjust in order to make sure that this is the case, and this is what's referred to as purchasing power parity. The idea that exchange rates are going to adjust in order to ensure that this law of one price is going to prevail. And when that occurs, when this purchasing power parity holds, and that law of one price is true, then it turns out that the real exchange rate is going to be equal to unity. It's going to be equal to 1 for these goods. Okay, and I'll explain what that means in just a second. So the real exchange rate we think about as the physical amount of goods that we can get for the same price in each country. So the example that we just looked at, this real exchange rate is the amount of German Mercedes-Benz we get per amount of U.S. Mercedes-Benz. So they're physical units of goods, how much we can actually buy in goods in one country as we transform our dollars into euros and purchasing power into another country. So why is it that this purchasing power parity should actually hold? Okay. Well, let's do a little exercise here. And let's suppose that the $75,000 Mercedes-Benz in the U.S. actually only costs 50,000 euro in Germany. So it turns out that those types of differences we can arbitrage. Remember, if purchasing power parity holds, it should be the case that the $75,000 Mercedes in the U.S. equivalently costs 60,000 euro with this exchange rate in Germany. Okay, so it's less than that in Germany. So it turns out we can arbitrage, we can take advantage of these discrepancies and actually make money. So let's see. So this is how this works, okay? If we're in the U.S., we can take $62,500, we convert that into euros, and it turns out if you make that conversion, that's going to be equivalent to 50,000 euros. Now, what do we do with the 50,000 euros? We go to the dealership in Germany, we buy our Mercedes-Benz, right? And then assuming that we can costlessly import this vehicle into the U.S., we can sell it, remember, for $75,000. That's the going rate for Mercedes in the U.S. So what did we do? We bought the Mercedes for the equivalent of $62,500 in dollars, and we sold it for $75,000. So you make a profit of $12,500 for doing not much, right? So the interpretation here is that you can make sort of costless, unlimited profits in this case, and because of that, because of these exchange rate differentials, that's going to arbitrage away these differences. And so through this arbitrage, you should expect exchange rate movements to move towards this purchasing power parity. And so this goes through some examples to talk about what the real exchange rate is in this case. This is a mistake, actually. This should be, that should read the exchange rate, not interest rate. Okay? And so you can go through this exercise and see what the real exchange rate is in terms of German Mercedes-Benz per U.S. Mercedes-Benz. And it turns out to be the equivalent of 1.2 to 1. And so the point of this is that because you have these exchange rate differentials, it provides this incentive for a bunch of profit-making opportunities by arbitraging these exchange rate differentials. And so the punchline is that there's going to be a demand for German and euro-denominated assets here is going to go up because we can make a lot of money by buying German Mercedes-Benz and importing them into the U.S. And as we'll see here in a minute, that's going to result in an appreciation of the euro relative to the dollar, and that's going to move this exchange rate to the point where, again, purchasing power parity will hold. And so at that point, then, you would expect the real exchange rate to be equal to unity, and there would be no more opportunities for arbitrage. So it turns out that there's other reasons for why purchasing power parity may not actually hold. Okay? So for one, it's quite possible that trade barriers could be in place. There could be restrictions on the movement of capital and other types of trade. So if there's quotas or tariffs in place, then that will prohibit this arbitrage of differences in exchange rates and prices between different countries. And so because of that, those barriers, that won't allow for this perfect exchange rate alignment through this purchasing power parity story. The second point is that there's non-tradable goods that occur in different countries. So the good example is thinking about a haircut. How do you arbitrage away the price of a haircut in different countries? It's really it's hard to import haircuts into another country, right? That's a service that's usually locally based. And so because of the extent to which these non-tradable goods might be interfering with the arbitrage opportunity, that could pull us away from purchasing power parity actually holding. The third point is that transportation costs. If transportation costs are high, then that can prohibit, again, this arbitraging of exchange rate differentials and lead us away from purchasing power parity. Again, in the example with the Mercedes-Benz, we assumed that it was costless to import this automobile into the U.S., when in fact that's not true. Automobiles are large, it's expensive to move them across the ocean, and there's import fees and all that kind of stuff that go along with it. So that's not a good assumption, and in particular, as these transportation costs gets higher, that's going to pull you, again, farther away from this purchasing power parity story. If there's specific product or brand preferences that people have in one country relative to another, then that could impede this purchasing power parity. Again, I gave the example of French wine versus California wine. If there's other country-specific things that people like for one thing rather than another, then that could drive a wedge between this purchasing power parity story. And then it could be the more practical aspect of the availability of information to be able to make these arbitrage choices. So, for instance, economic data could be really sparse. It could be dated. It could be unavailable. It could just take time to be able to get the data together to analyze it and figure out these arbitrage opportunities exist. And in the rare case, you could have governments that report statistics that are flawed or untrustworthy, which can create problems for this purchasing power parity story to hold. And then finally, if you look at this purchasing power parity story, we can actually, the Economist magazine has a measure of this purchasing power parity, which is a really interesting and common way to think about this. So what they do is they look at the price of Big Macs in a bunch of different countries, and then they translate that into US dollars terms, right? So if purchasing power parity holds, we should expect the dollar value of a Big Mac in all these different countries to translate to exactly the same thing in US dollars. And so you can see this column here, it gives the rundown for the dollar price of a Big Mac in all these different countries. And you can see that there's quite a wide range, all the way down from $1.82 in South Africa, all the way up to $7.51 in Norway. So what this suggests then is that this purchasing power parity story doesn't actually hold, and there's other factors going on, which I talked about, presumably, which are pulling us away from this purchasing power parity actually holding. And so that gets us again to thinking about these factors, these other factors that affect the long-run exchange rate. As I mentioned, the relative price levels, the basic idea here is if you have, for instance, the domestic price levels going up relative to the foreign price level, then what that means is that people are going to want to buy less domestic goods because they're more expensive, right? And they're going to want to buy more foreign goods. And the impact on that is because domestic goods are more expensive, the demand for domestic goods and assets goes down, and the domestic currency depreciates. If we put up trade barriers, for instance, if we have increased tariffs or increased quotas, the impact on that is going to be, it's going to increase the demand for domestic goods, sort of artificially through these trade barriers, and the impact on that is going to be to increase demand for domestic assets overall, and the domestic currency is going to appreciate. Again, if we have increased preferences for domestic goods over foreign goods, we like California wine versus French wine, then in that case, that's going to increase the demand for domestic goods. We would expect the domestic economy to appreciate, domestic currency rather, to appreciate. And then lastly, if we look at changes in productivity growth and the differentials between those two, again, we're thinking about one country relative to another when we're thinking about exchange rates. So we're really thinking about the differentials between these things. So if we have higher relative productivity growths in the domestic economy, for instance, typically we think about that in terms of the tradable or manufactured goods sectors. And so that higher productivity typically translates into lower production costs and therefore lower overall costs to those goods. And so the extent to which that translates to lower prices in those goods, that's going to lead to an increase in the demand for domestic denominated goods, and therefore the domestic currency you would expect to appreciate. And we'll see the mechanics behind this in the next chapter. So this gives you some idea of thinking about some of these different factors. So the relative price story again is represented by this red line. So if PPP held perfectly, then you would expect that exchange rates would really sort of track that red line. And so you can see this is the exchange rates of pounds per dollar. You can see that it's actually moved quite a bit from this. And so some of the other factors that we talked about are really driving this wedge between the actual exchange rate and what the PPP would actually dictate here. This just gives a summary of some of the things that I talked about in terms of what would be driving the exchange rates. And so the punchline here is, again, thinking about what's driving exchange rates, and there's two sort of windows into this story. The first is what's driving exchange rates in the long run, which is what we just talked about here. And so that's going to be driving longer-term trends in the exchange rate. In this example, in this slide that we looked at right here, again, you can see that the green exchange rate line in some ways sort of trends and tracks up a little bit relative to that red line. But there's other things going on behind the scenes that are obviously impacting it too. And so there's also shorter-term impacts that are going to be driving exchange rate differentials between countries and moving those exchange rates in different ways. And so that's the thing that we're going to look at in the second half of Chapter 17. Thank you.